So let's all get on the same page with our definitions and formulas. All of these definitions are in the lending and real estate industry for either residential or commercial loans and properties. Amortization is the process of gradually paying off a mortgage through regular monthly payments. These payments cover both the principal amount and the interest. Amortization periods are typically 15 or 30 years. This is called a fully amortized loan when the loan term and amortization are scheduled to end at the same time. Balloon mortgage. In contrast, a balloon mortgage loan is not fully amortized and requires a large payment at the end of the loan term. The borrower makes regular monthly payments, which may be interest only or include some principal, but the remaining balance is due in one lump sum at the end of the term. This would force the borrower to make a large lump sum payment, refinance if possible, or sell the property after the loan term. Debt-to-income ratio. The DTI compares the borrower's monthly debt payments to their monthly income. Lenders prefer a lower ratio to assure borrower affordability, as a high ratio implies that the borrower has a lot of debt relative to their income. There are two ratio types to be familiar with, but you likely won't need to deal with these on such a granular level. DTI is used exclusively for residential loans. Front-end ratio, also known as the housing ratio or top ratio, is a percentage that compares a borrower's monthly housing expenses, including mortgage payments, property taxes, insurance, and any applicable association fees, to their gross monthly income. This ratio assesses the borrower's ability to afford the mortgage. It's calculated by dividing the borrower's total monthly housing expenses by gross monthly income, then multiplying by 100 to express it as a percentage. Back-end ratio, also known as the total debt ratio or bottom ratio, compares a borrower's total monthly debt payments, including housing expenses, credit card payments, car loans, and other debts, to their gross monthly income. This ratio assesses the borrower's overall debt load and ability to manage additional debt. It's calculated by dividing all of the borrower's total monthly expenses by gross monthly income, then multiplying by 100 to express it as a percentage. Deed. A legal document that transfers ownership of property from one party to another. It includes details about the property and the parties involved in the transaction. Down payment, the amount of money the borrower pays at the time the loan closes. Escrow or impound account, a separate account where funds are held to pay property taxes and insurance premiums. The lender collects these funds as part of the monthly mortgage payment and pays the bills on behalf of the borrower. Home equity. It's the difference between the property's market value and the outstanding balance of any liens or mortgages on the property. It represents the owner's financial interest in the property. Negative equity occurs when the mortgage balance is more than the value of the property. That would also be referred to as an underwater property. Loan to value. LTV is a ratio that compares the loan amount to the appraised value of the property. It is used by lenders to assess risk. A lower LTV indicates less risk. A higher LTV puts the lender at risk as the borrower is financing more of the property. It is calculated by dividing the loan amount by the property's appraised value and multiplying by 100 to express it as a percentage. Mortgage, a loan used to purchase or refinance a property where the property itself serves as collateral. There are two types of mortgages regarding interest rates. There's fixed rate and there's adjustable rate. A fixed rate mortgage is the most common. It has a constant interest rate and monthly principal and interest payments that remain the same throughout the loan term. It provides predictability for the monthly payment. An adjustable rate mortgage, ARM, has an interest rate that can change periodically based on market conditions, which means monthly principal and interest payments can fluctuate. These types can adjust at certain intervals, such as annually. Many times they start with a fixed rate for a prescribed time and then adjust annually. The loan may have certain conditions to limit how high the rate cap or how low the rate floor that the interest rate can go. This long-term unpredictability is more risky and can cause payment shock or unaffordability for the borrower if the rate rises too high too quickly. We're almost done. Hang in for just 4 more definitions. Mortgage insurance premium. MIP is a type of mortgage insurance required for Federal Housing Administration (FHA) loans, protecting lenders in case of borrower default, and consists of both an upfront and annual premium. Private mortgage insurance (PMI) is a type of insurance that protects the lender if the borrower defaults on the loan. It is typically required when the borrower makes a down payment of less than 20% of the home's purchase price. Promissory note, a written promise to repay a specified amount of money under agreed terms to the lender. It includes details like the loan amount, interest rate, repayment schedule, and consequences of default. And finally, rate lock, an agreement between the borrower and lender that guarantees a specific interest rate for a set period, protecting the borrower from rate fluctuations during the loan processing. That's it for definitions and formulas. Thanks for bearing with me on these. In the next lesson, we'll talk about the definitions of residential and commercial properties.